The Fed went big at the September 2024 meeting with a 50 basis point rate cut. Given that this rate cut was predicated on getting ahead of potential economic weakness, we do think investors should be cautious going forward, but select opportunities will emerge from this recent Fed action. We think there are a lot of factors that will support higher long-term rates going forward. We don't see the Fed cut as necessarily being bullish for duration. But we do see this new rate environment as potentially driving a lot of rate volatility, given that market expectations are still differing from what the Fed is telling us. As we enter this new phase of the current rate cycle, we think attractive opportunities will emerge in EM local currency bonds, CLOs, and select areas of the investment grade and high yield corporate bond markets. There's been a positive story in EM for some time, given the relatively strong fundamentals and growth story, as well as the ability to benefit from higher commodity prices, but it's been very hard to fight against the strength of the US dollar. The rate cutting cycle that we've entered, we think takes away that headwind and also gives EM central banks more room to ease rates and support their local economies. EMLC provides broad exposure to this asset class. We don't see much benefit right now to going overweight duration, and the short end of the curve still provides the most attractive yields. And there are opportunities to earn attractive and significant pickup over the risk-free rate without taking on the risk of rate volatility, which we do expect to continue to see going forward. We think CLOs are the best opportunity at the short end right now. CLOs provide yields and spreads which are higher than bonds and loans with the same rating, and they have built-in risk protections to protect investors from credit loss. Investment-grade CLOs can be an attractive opportunity right now, with the uncertainty ahead, to stay high in quality. And in a core bond portfolio, they add yield, higher quality, and diversification. CLOI provides access to investment-grade collateralized loan obligations. Lower rated or mezzanine CLOs may also be attractive in a high yield portfolio, and right now may be a way for investors to de-risk their loan exposure. The Fed is concerned about slowing economic growth, and a lot of that will materialize in the loan market. In fact, we're already starting to see that. CLOs can insulate loan investors from losses in the loan portfolio because of the subordination they provide. We think an active approach, however, is really important in the CLO space because you do need to analyze every portfolio of every CLO you invest in. And that's going to become increasingly true in this new environment we find ourselves in. For investors who have been underweight duration over the last few years, it may be time to start looking at adding some of that back. And we think there are select opportunities in IG and high yield bonds. Within investment grade, historically focusing on the most attractively valued bonds has provided better outcomes. Given that we do see spread levels very tight right now, we think that's going to continue. MIG provides broad exposure to the investment-grade corporate market and focuses on the most attractively valued bonds within that space. And we also think that with the Fed cutting rates, opportunities for volatility and mispricings will emerge, and a strategy that focuses on attractively valued bonds will see many opportunities to add alpha. In high yield, it's a similar story with strong fundamentals, but very tight spreads. So we don't see a lot of upside from a spread perspective, and that does argue for staying high in quality. Looking ahead, however, given the expectations for slower growth going forward, we do think investors should keep an eye out for downgrades. Downgrades from investment grade to high yield have historically provided very attractive opportunities for fallen angel investors. ANGL provides higher quality high yield exposure and systematically buys bonds that are downgraded from investment grade to high yield. Thanks for listening. It's an exciting time to be a bond investor.